Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hey, audience and listeners, this is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing podcast. Today, I have James Eng from Old Capital, and we're going to go deep into the financing aspects of commercial real estate, specifically on apartment complexes. And James has over 15 years have underwritten more than $1 billion in assets, and he have worked with a lot of investors, a lot of active investors. And I believe he invests passively as well. Hey, James, say hi to our audience and listeners.
Hey, James. Thanks for having me. Love your first name. So let's get it going.
Of course, we love that first name, right? So why not you tell about how did you end up to become a director at the Old Capital, and what was your journey since you started in real estate and financing?
Yeah, so I was born and raised in Houston. Went to school in Austin, where you're at UT, and then I came out of school, worked at GE Capital for 10 years, and one of those roles at GE Capital, I was in commercial real estate, and I was a loan underwriter. And so, as a loan underwriter, I looked at the balance sheets of all these commercial real estate operators, and saw that these guys made a ton more than attorneys and dentists and doctors. And I said, man, I really need to start figuring out how to invest in real estate. And, I was at GE during sort of the great financial crisis, and the only property types we did not take back in terms of foreclosure were apartments and self-storage. And so I was like, I need to figure out how to invest in these two things. And apartments just were easier for me to understand and easier for me to get into. And so everywhere I went, to every Dallas meetup in 2014, all I saw was Paul Peebles and Old Capital and Michael Becker everywhere. And so I said, I need to figure out how to work with these guys. And in 2015, Blackstone came in and bought GE's entire real estate portfolio of about $40 billion. And so I found myself without anywhere to go in February of 2015, because Blackstone said, we don't need any of you guys. And so I went and worked at Old Capital and essentially sat in the car with Paul Peebles for 6 months, driving around looking at Class B and C properties. And from there, really learned the business. And since then, have done close to $1 billion in multifamily loans over the last 5 or 6 years, invested in close to 30 projects throughout Dallas, Austin, and San Antonio on the multifamily side. And so have been, I would say, somewhat of an expert or built somewhat of an expert following around multifamily financing and investing.
Awesome. Yeah, I mean, I started in 2015, and I used to do a lot of business with Old Capital, and I know you came like after a few years from there, right? So that's good. Good that I think you joined a really good team over there in Dallas. And so what did you? I mean, so first of all, GE Capital, right? Because I've heard GE Capital in different places. What they were doing previously, and as a loan underwriter, how much was that volume is multifamily?
Yeah, so I mean, we did bridge loans and CMBS loans. So bridge loans are sort of 3 to 5 year, sort of fixing a property, so heavy value add. And then the CMBS loans were the stabilized loans. And so we probably only did 10 to 15% in multifamily, because Fannie and Freddie were so aggressive in the space. Whereas in office, industrial, retail, self-storage, there's no Fannie Freddie. So you don't really have as many non-recourse options. And so a lot of people do bridge loans in that space And so I did a lot of those different asset types. And when I did multifamily, I loved it. And so it was always a little bit easier to underwrite, a little bit more conservative. And we usually were doing deals out of lease up. So there were new construction deals out of lease up, and then we might put a bridge on it, or we did student housing deals. So we did a lot more student housing deals on the bridge side than conventional multifamily.
Awesome. So you give me a really good segue, because I really want to go into the mindset of a loan underwriter, because I've talked to a lot of active investors on how do they underwrite, how kind of sniff tests do they do. So from a loan underwriter, I mean, even right now you're underwriting loan as well, right? So what do you look for when somebody gave you, hey, James, I wanna, can you underwrite this deal for me? I want to get a loan, right? What are the sniff tests do you do before you throw it away, say that it doesn't work, and how do you take it to the next level? Say that, okay, this might be a really good deal that I can finance, or our company would be interested in financing it.
Yeah, I mean, it always starts with the underwritten NOI, right? So you're starting with sort of your basic T3, T6, T12 on the income side. And then on the expenses, you're really underwriting to the pro forma of the borrower, and then probably T12 on utilities. And so once you do that, that's sort of your base set. The advantage I have now is that I've seen enough multifamily deals in Texas that you can pretty much underwrite a deal in 5 minutes and get to sort of what that deal can size to on just sort of your in-place NOI. That's number one. And so if you're doing a stabilized deal like a Fannie or Freddie deal, that underwritten NOI is what everybody hangs their hat on. If you're doing a bridge loan or some sort of heavy value add, then the more important thing is, all right, what are you going to take the NOI to, and how are you going to grow the rents? And so understanding the rent comps, understanding what rehab you need to do, that's what the underwriter starts spending their time on. And that's at the property level, right? So I like to think of, you've got to underwrite the sponsor, and then you've got to underwrite the property. And so to me, it always starts at the property level, because a lot of these loans are non-recourse. And so if you don't like the property, then you're not going to do the loan. But once you get over to the bridge side, you really start underwriting more of the sponsor, and have they done this before? And I think that's probably where most people get into the most trouble, is they don't have a track record. And so they have to start partnering with other people to build up that experience. And then once they have the experience, it's like a golden star, I guess, on your chest. And as soon as you have the experience, then you can pretty much buy anything. And so that's one of the unique things about multifamily, is that you have to sort of partner with other people to build your experience. And then once you have it, then you can utilize it on pretty much any other property going forward.
Yeah, interesting. So I want to go a bit more detail on the NOI of a deal, right? Because usually the lenders, in my experience, I mean, yeah, they look at T12, T6, but T3, I mean, T3 is basically the last 3 months. T3 means T is current T, and then -3 is 3 months. So T3 can be manipulated by a lot of sellers, right? Because just before selling, past next 3 years, they can put all kind of really bad residents, qualified residents, and they can push up the NOI, right? So does the lenders really care at all, or they just look at the numbers? Because my experience is they just look at T3, or T3 is good, we're going to give to the max lending capacity of that T3, right, of the NOI, or at least on the income side, right?
Yeah. So what Fannie and Freddie have started doing sort of post-COVID is really digging into collections. So it's not just what you're putting on your income statement, what's actually being collected in cash, right?
Okay.
So some lenders are digging in hard. Like Fannie and Freddie won't necessarily ask for bank statements, but they could, right? So bank statements from the seller showing the collections for the last 3 months. We've seen some deals where that's popped up. We've also seen not only just the income statement, they've asked for accounts receivable, and they want to see a delinquency report on these deals, because, on, let's say, an accrual basis, if everything looks great, right? But then when you find out that, you have $20,000 in bad debt that's going to be written off after you close, then it doesn't look as great, right? So I think every buyer in today's market sort of has to build that in a little bit. Like, even though you might be 90, 95%, after you close, there's probably going to be some cleaning of the residency out, and you're probably going to drop to 85% in the first couple months as you go through the rent roll and walk all the units.
Oh, so you're saying nowadays Fannie and Freddie are looking at, I think it depends on the deal and depends on the sponsor. Maybe they're looking at a bit more detail, I guess, right? Just to make sure that.
Yeah, on collections for sure.
On collections. Okay, interesting. Okay. And what about, so basically, so collections will be the true numbers, right? You can't really run away from that, other than whatever reported on the financial statements, right? So coming back to, your experience, because you started in 2015, you have seen Dallas has grown like, I think I know you, I think you do nationwide, but you have done a lot more deals in Dallas. So what have you seen in terms of the demographic shift of the active investors? I think there's a lot of, why not you answer that question? What do you see in terms of the mindset and who's coming into the game, into the syndication game nowadays, right? For the past, 6 to 7 years, because there's a lot of change could have happened in the past 6 to 7 years. There's a lot of new players. So what have you seen?
I think the people who came in 2015, they're still in the game, and they're still buying deals. The people who sort of left the market, I would say, are the guys who came in super early. So super early was like 2010, 11, 12, and they were buying deals for like 10,000 a unit. Those guys find it very difficult to buy a deal at 100 a unit.
I know.
But the syndicators that I started working with, let's say in 2014, 2015, they bought deals at 30 to 48,000 a unit, and then they moved up and they bought deals at 70 a unit, now 100 a unit, on sort of B minus C deals in Dallas. They're still here and they're still buying deals. And, obviously the rents have improved. I would say some people have moved up in class, right? So instead of buying a 1960s or 1970s property, they're buying a 2000 or 2010 property right now, because it's really just a function of how much equity you can raise. So if you can go out and raise 10, 15, $20 million, then you can go buy a Class A deal in Dallas right now. And your cap rate is not going to be that much different than a B or C deal. And so a lot of people are just moving up in class, whereas the people who are just starting, they're buying the B and C deals.
Oh, interesting. So you're saying that just because there's not much differentiation factor in the cap rate between classes right now in Dallas, and it just maybe makes sense more to buy Class A, right? Because you'd probably need to raise more.
If you can raise the money, right?
Yeah.
Because Class A deals, let's say it's 200 a door, and you want to buy a 250 unit deal, then all of a sudden you're raising $20 million. And so most people who are just starting can't raise that much money. So the people typically buy a BC deal, they can raise, let's say $5 million, or they partner with a couple of guys, they raise $5 million, they get a $15 million deal done. And that was back in 2015, 2016. Now they have a track record, they sold that deal. Now they're moving up to the $30 million or $40 million deal.
Got it. Don't you think the prices, of course, when you look at price per door, everything sounds crazy, right? Because, when I started, I used to buy like 35, 40, 50 a door kind of thing. But now it's all like, 80 to 120, 150. If you come to Austin, it's just so crazy over here. I'm sure even in Dallas, it's getting crazy. Do you think people can still do deals with all that price per doors?
I think it's all relative, right? So in February of 2000, let's say pre-COVID, right? My savings account was giving me like, let's say $1,000 a month. It went to like $10 a month.
Mm-hmm. Yeah, I know. It was like
So,
0.1%.
Yeah, it went literally to zero. And so for people who have cash on the sidelines right now, and you're saying, I get it, I can't give you 10% cash on a multifamily value add deal right now, but I can give you 6 or 5. Compared to 0.01%, that is
phenomenal.
2000x. I don't know what the number is.
Yeah.
And the amount, and these are deals that, we're raising money, we're getting 10-year either fixed rate or floating rate debt. Our debt is essentially set. We have a business plan to go in, do 5,000 a door in rehab. We're going to raise rents $50 to $75, and it's B and C or A minus deals where the whole time during COVID, during lockdowns, we're at 95% collections. and you have a diversified income stream across 200 tenants, I mean, most people are still agreeing with that. I think the concept, or what's probably harder for people right now raising equity, is just like, is this the right time? Right? Is this the right time? Everyone's getting vaccinated. They're still rolling everything out. Is this the right time to jump in? And so I mean, in 2015, everyone thought that was the top when I started. And so I just said, look, I'm going to invest in a deal a quarter, essentially. And that's what I've done the last 5 years, 6 years. And I don't know when the top is, but I just find good operators, good located properties, and invest over time.
Got it. So I'm not sure. I mean, how much do you know about Austin, San Antonio, Houston? I mean, I know you know Dallas pretty well. So I mean, do you want to go deep into that market? I'm sure
Yeah,
because All Capital
I
is a huge group, right? I mean, I'm sure.
yeah, I mean, what I've seen, and like I put together just a snapshot, because a lot of people coming from outside of Texas are like, so what's the difference in the four major markets? And I would say in size, Dallas and Houston by far are twice the size of Austin and San Antonio. And so a lot of times, just with headlines, you think Austin is huge, but Austin
How
is
much
probably
inventory here?
yeah, 2 to 3 million people in Austin versus 7 to 8 million in Dallas, and
Yeah.
7 to 8 million in Houston. And so in 2020, in terms of multifamily transaction, Dallas was the number one market in the nation. They had $10 billion in multifamily transactions last year. Austin and San Antonio was about 3 billion. Austin was about 3 billion. San Antonio was about 2 billion. So I would say Austin is probably the most expensive market in Texas for sure. And the number one thing driving Austin is tech. And that's going to go great until at some point there's going to be a pullback in tech. And so that is probably the only thing that is not baked in to Austin. The cap rates in Austin are probably 50 basis points lower than Dallas, right? So if in Dallas, you're probably a 4 to 4.75, 5% cap rates right now from ABC. Austin, you're probably 50 basis points lower. So you're probably 350 to 425, 4.5 on cap rates. San Antonio is probably opposite. It's probably 50 basis points the other way compared to Dallas. You're probably 4.5 to 5.5%. I would say San Antonio is a smaller market of all four of them, right? So San Antonio is going to be a smaller market than all four of the other majors. And then Houston, I would say Houston is still dependent on oil as much as anybody wants to say, there's the Texas Medical Center. But outside of that, I mean, if you drive along I-10, I grew up I-10 and Beltway 8 in sort of West Houston. I mean, all those buildings are, energy buildings. And those were all the top, white collar professionals live and work. And Class A deals in Houston, the rents have gone straight down for the last 2 or 3 years. And so Houston's having a little bit more trouble, I would say, than any other market, probably in Texas right now.
Yeah. Yeah. When I started like 2015, I remember Houston being like what Dallas is right now, the top market for the, 5 years before that, right? It was always number one in the nation. And I'm not sure what happened to Houston, maybe because of, hurricanes and
hurricane and oil.
Yeah, these two things made it a bit less popular, right? So in terms of financing, I know Houston used to be a pre-review market for Fannie and Freddie. Are they still a pre-review market?
For Fannie, yes. So what we've done a lot more Freddie, Freddie SBL, which is under 7.5 million or under 6 million really in Houston. And then Freddie conventional has been fine. They usually just want a higher debt service. So you might be, instead of 75, 125 on the debt service, it's usually 75% levered and then 130 debt service in Houston.
Interesting. Okay, got it. So they still have some limitations on Houston, but I think, I don't know, sometimes it can be, looked at as opportunity, right? Because people are, slightly not doing a lot of deals over there compared to, other markets, I guess, right?
Yeah, I mean, it's probably, if you say, let's say a B deal in DFW right now is 125 a unit, just say on average, then in Houston, you're probably 100 a unit. So you're probably 25,000 a door cheaper. You're getting a higher cap rate there. I would just make sure instead of $500 $1,000 a unit in insurance, you're probably $800-900 per unit in insurance in Houston.
Got it. So let's go and talk about different loan products, because you would be able to give a lot of insight, right? You have CMBS, you have bridge loans, you have Fannie, Freddie, and you have HUD loans, and you have conventional bank, right? So you have like 6 different loans, if I did my math correctly, right? So
Right.
why not you look at the pro and cons of each one of that, so that at least we can give some really good education for our audience here.
Yeah, let's start with where most people start, recourse bank loan, right? So this is going to be a 5-year, maybe 1-year interest only, 20 to 25-year AM, and this is going to be recourse to you, right? So you are going to sign personally. Most of these loans are $1 to $5 million in that range. Most people only sign them on their first loan, and only if you can't get Fannie or Freddie. So if your occupancy is 70% or 80%, you can't get Fannie Freddie, you use a recourse bank loan on deals under 5 million. If as deals get more stabilized, you get more experience, most people are moving to Fannie and Freddie. So Fannie and Freddie are going to be 5, 7, 10-year terms, non-recourse, 30-year amortization. You can get anywhere from 1 to 5 years interest only. Rates on Fannie and Freddie right now are probably 325 to 375, just depending on your prepayment structure. And that is the market. I would say in 2020, it was the market. Probably 70 to 80% of the loans done on the multifamily side were Fannie and Freddie. And so you had to understand that market. And that's what we did a lot of. If a deal doesn't qualify Fannie and Freddie, you could go non-recourse bridge. So this is what I did at GE Capital. A lot of non-recourse bridge loans are 75 to 80% loan to cost. So if a deal just isn't sizing well on Fannie and Freddie, you could do a non-recourse bridge. This is going to be 3 to 5 years. IO the whole term. You're probably 4.25 to 4.5%, but you get a 1% prepay, which is a huge advantage, and you get more leverage. And then CMBS, I would say, is for your stabilized product that just is not, they want a non-recourse loan, but there's been some issue that Fannie and Freddie can't get over. So it could be in a pre-review market, like we talked about, or it could be there was recent crime on the property, or the guarantor just doesn't qualify Fannie and Freddie. So they had recent bankruptcies or things like that. Then you could take it CMBS. CMBS is going to be 10-year. They could probably do up to 3 years interest only, and up to 75% leverage. And their rates are probably a little bit more than Fannie or Freddie, but not much. So they're probably still in the 4% range on CMBS. And then HUD is really used. We've seen it used. We just did a deal in Austin on a 221 D4 HUD loan. So it's a non-recourse construction product. You can get up to 85% loan to cost on it. And it's for areas where there's not a lot of new construction. So if they do sort of like a demand study, a market survey, and figure out what areas you could build it in, and then you can do that construction product. And they also have a refinance product, but HUD loans take anywhere from 6 to 9 months to do. So most people are doing it either on construction or refinances, not on acquisitions. So acquisitions, doing just your recourse bank loan or Fannie or Freddie. Oh, you're on mute.
Oh, okay. So it's good that, we have different products that anybody can use, right? I want to go a bit more into the market cycle of this product, but before that, I want to go to the bridge loan, right? So the bridge loan, usually they give you like 3 years loan product, and there's 1+1 extension. If I'm not mistaken, that's the most common product, right? So I never done a true bridge loan. I've done a bank loan. I've done Fannie and Freddie and all that, right? So I never done a CMBS, right? And on the bridge, so the additional 1+1, is that based on the lender's approval? You get it? Okay, it's not like automatically you get it, right? So
yeah, so they usually put some hurdles around it. So it might be a debt service coverage hurdle. So it might be like a 125 or 135 debt service coverage hurdle, or it might even be what's called a debt yield, is a NOI divided by your loan amount. So it might be like a 7 or 8% debt yield hurdle, depending on the lender. And they typically charge, let's say, 25 basis points or 50 basis points for each extension. And so ideally, if you're doing a bridge loan in year 2, you're starting to look at, all right, how am I going to refinance this to Fannie and Freddie, or how am I going to sell this deal? You don't want to come up against that maturity.
Yeah, it's yeah. Sometimes I mean, yeah, I mean, it's we have to go into the detail on what are the extensions of that bridge loan, right? So let's talk about different market cycle and different loan products, right? So like before 2020, before COVID, what kind of loan product would you advise? And what, like right now, what are the loan product that would you advise? I know it depends on the deal and all that, but at a very high level, can you describe your expertise, for an active sponsor or active investor? How would they choose which loan product to use?
Yeah, I mean, 2015, 2016, almost everybody sort of on the B and C side was using just Fannie Mae fixed rate. And that's, you were getting 75 to 80% loan to cost. And it was a great product. You're probably 4% interest rate, 4.5% interest rate. 2018, 2019, what happened was Fannie Mae was 70% or 65%. So more people started using bridge loans in 2018, 2019. 2020 hit, all the bridge loans went away. So post-COVID, all the bridge lenders went away. All that was left was Fannie and Freddie. And at the end of 2020, what really changed was Freddie started being more competitive in the probably B, C space. So class B, class C space. And a lot of people started using Freddie floating rate debt. And what that gave you was a 10-year loan term instead of 5 years, which is what you get on most bridge loans. It gave you a 10-year loan term, and then it gave you a 1% prepay after 12 months. And so they did a ton of business in Q3 and Q4, but they started becoming a lot more restrictive starting this year. So I think a lot of BNC syndicators will probably start going back to Fannie Mae. The question is whether they want to do fixed rate or they want to do floating rate, or even potentially a lower prepayment penalty. So we're starting to quote Fannie Mae with not just your standard yield maintenance. We're doing maybe shorter yield maintenance or even step down prepayment penalties because people are getting stuck with yield maintenance penalties from 2017, 18, 19.
Yeah, that's including me too. I mean, we are stuck with prepayment penalty, right? Because everybody's thinking the interest is going to go up, but it went down, right? Which means our penalty become bigger right now, right?
Yeah, very tricky.
Which is a counterproductive from where we wanted to be in terms of our business plan. But so where do you think we are going to go from here in terms of the lending environment? Because right now, Fannie and Freddie has this reserve requirement, right? Primarily due to COVID, and they're still not out of the woods on that. Where are we going to go with that?
Yeah, I mean, Fannie and Freddie are still a huge portion of the market. They really want to be like 50% of the market. They're probably 75% of the market right now. And so everybody's still coming to them because the interest rate is 3.25%, 3.5%, which is great, fixed for 10 years, or even their floating rate product starts at 3.25. So that's just phenomenal. And you're getting 4 years of IO or 5 years of IO. And so people are just all over that, and it's non-recourse. And then you get the certainty that Fannie and Freddie aren't going anywhere, right? So if Fannie and Freddie were closing loans during COVID, right after during lockdown, then for the next year they'll be here. And so a lot of people are counting on them to be in the market. And as a syndicator, when you have 250 or 500,000 day one hard, you want to make sure your loan funds, right? So I think the COVID reserves will slowly start coming off. They used to be P&I with taxes, with insurance, with replacement reserves, which was about 10% of the loan. Right now, it's just P&I, so it's 5% of the loan approximately. And I think they're going to start scaling that back down to maybe 6 months, and then eventually take it off. But until other lenders come into the market and are more competitive, they can just leave them on, because from Fannie Mae and Freddie Mac's perspective, these are the best loans they've done, because not only are they sizing the same way on debt service, right? Because they're looking at in-place income, but they're having you put up 6, 9, 12 months of P&I. And so they've got an extra cushion there to make their loans even safer.
Yeah. I think I don't know. I think once the reserve prices reserve requirement has been taken off, I think there's going to be a lot more movement in terms of transaction, right? Because the numbers would be much better, right? So do you think right now with COVID, multifamily prices really didn't come down. In fact, it went up more, right, because of the lower interest rates. But selling right now a deal with a where you can sell right now versus selling it after the reserve requirement is over and vaccines or everything's over with COVID, right? So what would you propose right now? For an active investor, selling it right now where interest rate is still low. I don't know where the interest is going to be in the next few years. I think it's going to be the same for next 2-3 years. That's what the Fed has been telling us, right? Selling right now versus selling, 1 year down the road where everything is back to normal in terms of the lending liquidity.
My opinion, and so I've invested in 28 deals and 10 have sold in the last 3 years.
3 years?
And as
3 years or
soon
3 months?
as, yeah, last 3 years, not
Okay.
3 months. Yeah.
Okay.
A lot sold in 19 and 20, right?
Okay, got it.
And the reason that they sold was they had not held the deal for 5 years as projected, but they could hit their return when they sold, even though they had a prepayment penalty, even though it was year 3 and not year 5. And so if you can hit that price and that return back to your investors, because in reality, as a general partner, your biggest payday is when you sell your property.
Mm-hmm.
Right. And almost every syndicator or that raises money, they're going to ask, all right, show me your full cycle deals. How many deals? Because not until you sell the deal is that a sort of realized return, right? So everything's unrealized until you actually sell the deal. So that I think is important. So if you're trying to build a track record, if you can hit your number now, because I've seen where syndicators, they've taken a bridge loan or they passed on an offer and then all of a sudden a building catches on fire or a hurricane hits or, anything can happen at these properties. And all of a sudden now you thought you were going to hold the deal and sell it this year, but now, 10 units are down. So now you got to bring those back up or the hurricane hits, anything can happen. And so if you can hit your business plan, execute it, sell the deal, you've held the deal for 2 or 3 years and return all the money to the LPs. I think that's a great plan as a syndicator. As an individual owner, I think that's where it becomes a little bit different is when you start thinking about, all right, am I going to hold this property long-term? Then, and it's going well, I've done all the work, I've acquired it. Now it's just making sure you have enough capital because that is usually the next reason why syndicators need to sell a deal is they came in, did the plan, they used all their CapEx dollars. Now they're sitting in year 4, year 5, they don't have any money, right? They might have 100, 200,000 in working capital, but it's not enough to do the roof. It's not enough to do 50% of the units interior upgrades, right? So they have to go and sell the deal.
Yeah. CapEx is very key, right? Because sometimes you burn through too quick or you underestimated your CapEx and, you rather just sell it and claim the victory saying that we did a good turnaround rather than saying that now we want to continue but we don't have CapEx, right? Which is not that.
Yeah, we're doing a capital call. And
correct.
Limited partners are looking at you like you're crazy.
Correct. Where do you think, I'm sure you're looking at a lot of deals nowadays, right? For the past, 9 months or 12 months during COVID. We're already like 11 months right now, right? So where do you think is the biggest opportunity for investors, for active investors to make an impact right now? What kind of deal? What kind of deal do you see that's a really good deal? I should have done that.
I still like probably the A- B+ space. So a lot of B and C deals have been upgraded. They've raised rents from $900 to $1,000 or $1,100. The space between the new construction. So new construction, let's say in DFW, the rents are $1,500 to $2,000, right? I don't want to be in that space really. Because there's 20,000, 30,000 units coming online. And as soon as the new one comes in, everyone moves to that one because they're given 2 months free, right? Mm-hmm. So I'm constantly fighting those new construction guys. And so it's hard to push my rent above $1,500 a unit. But if I'm an A- deal, B+ deal, and my rents are $1,100 or $1,200, and I can push to $1,300 or $1,400, I feel a lot better with that play. And a lot of those deals, the deals built in the 90s or early 2000s, those haven't been touched. So they've sat there for 20 years. Interiors are white appliances, white cabinets, carpet, and the amenity set is probably a little weak. And it's garden style, 3-story walk up. And I can park, in front of my unit and walk up, and I don't have to get an elevator. I like all of that. In DFW, in Austin, I like that play. And most of those deals have not been touched.
Got it. So what you're saying is B and C, a lot of it's already been done right now, but people forgot about the A- product.
It's not they forgot. It's just it 5-10 years ago it was brand new, right? But now it's older, right? And so there's so much new supply that's come on that the new supply is structured parking with a wrap, 4-story wrap, and it's $2,000 a unit or $2,000 a month in rent. And a lot of people are like, I don't want to pay $2,000 a month, and so I'd rather rent a $1,200 or $1,300 Class A- deal in the suburbs, and I can walk up to my unit.
Yeah, that's good. What about on the different loan types, right? Like there's a loan assumption, there's new loans, and there's other.
I mean, if you can do a new loan on a deal, and you can do a Freddie floater. Freddie floater is by far the best product right now. They're going to be more conservative on their taxes. They're going to be more conservative on their leverage. But if you can get in the fourth quarter of last year, we were doing loans with 10-year term, 5 years IO, 260, 270 over SOFR. SOFR's 10 basis points. And to me, that was a home run. This year it'll probably be 300 basis points, 325 over SOFR. But you have a 12-month lockout and 1% prepay. So if anybody comes to you in year 2, 3, 4, you could sell and you have a 1% prepay and you're out. But then it gives you also you don't have a loan maturity in year 3. You have a loan maturity in year 10. And so you can just sit there and you buy an interest rate cap. And that is a phenomenal product, but they're going to be stricter. Freddie's going to be stricter on the quality of the asset and quality of their sponsorship this year. And so you're going to have, someone like yourself, you're going to have enough experience, but someone who's done maybe 1 or 2 deals, it's going to be tougher for them to qualify for a Freddie loan this year.
Yeah. I love the Freddie floater nowadays, right? That's really the 1% prepay is I was just wondered why we were not introduced to that loan product during the normal time, right? So
if you go back to 16, 17, 18, everyone thought interest rates were going to go up, right? And so if you did the Freddie floater, then you had to buy an interest rate cap.
You had to buy a cap, yeah.
So that interest rate cap might have cost you $500,000 at close.
Okay, got it.
So do you want to bring $500,000 to close, or right now, because everyone's thinking that interest rates are going to be flat, the interest rate caps are like $50,000. So people can stomach $50,000 at close, but most people, especially on like a $8 million or $9 million deal, you got to bring $500,000 or $400,000 to close. It was just too heavy.
Oh, okay. So the cap is a fixed amount, I guess, like $500,000, regardless of the deal.
Well, no, they look at what do you want to cap it at, right? So if SOFR right now is 10 basis points and you want to cap SOFR at 1%, it's going to be 50,000, right? If you want to cap it at 2%, it might be 40,000, right? Whereas pre-COVID, let's say 2017, 18, 19, if they think interest rates are going to go straight up, like that was the forward curve, then if you want a 1% cap, it's going to cost you a lot of money, because as soon as it goes past 1%, they have to pay you. And so not many people wanted to take that trade.
Got it. Yeah, it's always, I realize the cap is what makes the difference, because nowadays it's pretty cheap to buy the cap, right? The maximum interest rate cap compared to last time, and people really probably didn't even were introduced to that concept. Very interesting. So as an LP, let's go into more into passive investors, right? What do you think is important of a sponsor's financing for the LP? What are the things that the LP should be looking for when they are going to invest in a deal on a sponsor's financing?
Yeah, I mean, I think it's important to understand what it is, number one. So is it Fannie? Is it Freddie? Is it Bridge? Um, because you're going to have to understand the exit, right? So if, let's say it's a Fannie or Freddie loan, and the exit is in year 5, which is what 99% of sponsors project. And if you project a 5-year exit and you have a 10-year loan, then what's the prepay in year 5? And are you accounting for it? So that's what I would say is number one. Most sponsors that I see, they do Fannie and Freddie, right? If your sponsor is doing a bridge loan and in year 3, what's the exit, right? Do you have a clear path to a refinance or a sell? And if you do not, then my equity is at risk as a limited partner if you do a bridge loan. And most bridge loans on syndications are non-recourse bridge loans. So that person does not have any of their personal money at risk to make up for that loan versus a recourse bank loan, you would. So that's what I would understand is it Fannie Freddie? What's the term? And then what's the exit? Is it, 1% prepay? Is it yield maintenance? Is it step down? So how do I get out of the loan?
Got it. So let's go into your personal side of things, right? I mean, you do a lot of loan underwriting, you do loan origination. Do you look at? I think you do as an LP as well. You invested in 28 deals, right? Are you looking yourself one day to be an active investor?
Right now, no. I mean, I work. What's nice is, I see a lot of transactions, and so I've invested in a lot of transactions, and so every month, we're recording this in the middle of the month. I get essentially 20 monthly reports from all over DFW, from Austin, and from San Antonio, and so that makes what I like about that is that I can become a better investor every month compared to when I invested in the stock market. I bought the same S&P 500 index fund for 10 years, right? I never became a better investor. And so I think the combination of most people, they're going to probably at least start as an LP and then make their way to becoming a general partner. But for me, I've stayed on the limited partnership side because for me to do loans, that takes enough of my time. So if I'm going to have any life outside of multifamily, I can't be a GP. I can't be a loan originator. The nice thing is, if I went from 20 LP deals to 50 LP deals to 100 LP deals, it wouldn't matter because it would be the exact same amount of time, 0 for me to do. So that's where I've chosen to spend my time is loan originations, working with general partners, and then LP deals as an investor.
Got it. So where do you see yourself growing from here? I mean, I know you said talk about I can keep on doing LP, right? But where do you see yourself progressing in your career or in a in your life?
Yeah, so I mean, so the last 5 or 6 years, I've been focused more on sort of originating loans for myself and for Old Capital, and the past year I've been sort of tagged me and Paul to sort of figure out how to grow Old Capital from we do about $1 billion a year in loans to 2 to 3 billion. So really just doubling over the next 2 to 3 years. And so we've actually just hired people in Atlanta. We're looking at adding some people in Phoenix and Florida, and then potentially in the other markets here in Texas. So we have people in Austin and Houston right now. We'll probably add someone in San Antonio. But we have a good group here in Dallas, but in the major Texas markets, we'll probably be adding some folks there and really growing because I think the number of transactions that are going to happen in Texas is only going to continue to grow, and just really expanding sort of the whole Old Capital brand and name across multiple cities, I think is sort of the next step. And so that's sort of my next 3 to 5 years.
Got it. So let's look at some of among all the transactions you have done, among all the loans that you have done, is there any one particular loan or some help that you did to a sponsor or syndicator that you're really, really proud of, that, it's
I
always
mean,
in your mind, you're really proud of that, I really helped this guy or this person or this group out, and I'm just happy because I helped them. You can go into details, but you don't have to go details.
every single deal,
Okay.
I feel like is so unique. And I mean, there's deals that essentially, people call me after the deal's blown up, right? So they've been working with another lender. They've gone down the road for 30 days or 45 days and they haven't gotten anywhere. And they call me and say, look, I mean, this happened at the end of 2020. They said another mortgage broker was working on this deal for 3 weeks, 4 weeks, got nowhere. I don't have one quote from anybody. And they told me about the deal over the phone in 10 minutes. And then the next day I had a loan quote for them. And that person closed at the end of January of 2021. And a lot of times it's really just knowing the market and, all the inputs of what is going into the deal, who the borrower is, who the sponsor is, and hearing that story and figuring out the right place to put that. And so a lot of people in this business, they do office loans or retail loans and self-storage loans. Like, we almost exclusively focus on multifamily. So if you bring me a multifamily deal that has an issue, we can figure it out. And so a lot of times we are the problem solver at the very beginning. And what happens is those people become clients sort of forever after you solve their problem once, because if they can't get that loan closed, they're probably not doing a deal with that listing broker again. And so there's a ton of pressure. They have a ton of hard money. And so that's just one example. There's been other examples where, I've probably closed, 150 loans over the last 4 or 5 years. And so we see a lot of settlement statements. We see a lot of issues with, let's say, title, insurance, all those things that are sort of ancillary to a transaction. And a lot of times we can bring up other transactions and say, look, this title company did it this way, or this insurance company did it this way, or this guy looked at the flood zone this way. And we have those connections. And so I think a lot of times people think, all right, well, you're just helping me with the loan and that's all you can do. So just give me the lowest interest rate. And I'm like, I got that, I can do that. But then all the other ancillary pieces are where I think we add a ton of value.
Got it. Awesome. So James, why not you tell our audience how to get hold of you, and any website reference, any links that you want to give out so that people can connect to you.
Yeah, I mean, the company's website is oldcapitallending.com. You can go to YouTube. So just search James Eng, YouTube, Multifamily Financing. There'll be, I've probably done 100 videos since post-COVID on YouTube. So that's probably the second place. And then I'll just give my email. It's jeng@oldcapitallending.com. And my phone number is 214-300-5035. Happy to talk with anybody about financing, investing, multifamily, anywhere in the nation.
Awesome. Is that your cell phone or your office number?
Yeah, that'll go to my cell, so you can text me there.
All right, guys, or girls, you all can call him directly. So thanks for coming on. I think we went pretty deep into a lot of, financing aspect of multifamily. And you're right. You want to focus on one asset class because there's so much of details in that asset class. You need to be specialized, right? And I've seen, sometimes I get attracted to shiny objects. So why not I do self-storage? Why not I do mobile home parks? But, it's very important to focus, because, once you focus on it, you become really, really expert on it and you can grow pretty quickly, So thank you for coming to the show.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.